Hi folks, Chuck Gibson from Financial Perspectives with January 2018's Charts on the Move. January turned out to be a barn burner for risk assets. The S&P 500 and Europe's broad stock indexes were both up 5%. The emerging markets, however, climbed 8%, but bond markets around the world fell. While January was a great follow-through to 2017's close, the month ended weaker and provided some signs it's tiring and is in need of a rest. Equity inflows had the biggest start to a new year ever, which is a reflection of sentiment gone wild. The volatility index, a measure of fear in the markets, rose to a 5-month high, closing the month out some 50% higher than it did just 1 month ago. This is not normal, because during rising markets, fear should be falling, not rising. We ended January with many technical indicators stretched to the max, highlighting both the strength of this bull market, but also the need for a rest. The last 5% pullback was more than 15 months ago. The last 10%? 2 years ago. And a 20% pullback? Well, that last happened more than 6 years ago. I gotta tell you, this is not normal. Any pullback within this longer-term uptrend would be a healthy step to unwind the current frothiness if we want the markets to eventually go higher. No one wants to go through them, but they are necessary to extend bull markets. U.S. equities have already gained more in the first month of January than they do in many full years. The recent trend is being termed unprecedented and unsustainable, but it's really not that unusual, and in most prior cases, equities have continued higher. Here are some statistics looking at what happened in years past when January gains were more than 5%. As you can see, the market tended to close the year very strongly, with strong double-digit gains, the only exception being 1987. And while we have not yet closed out the quarter, here are some statistics showing the yearly performance when the first quarter started out with a gain. Like the monthly stats above, the numbers strongly suggest 2018 should be a good year. Of all the instances, more than 95% of the years ended with a positive return when starting off the first quarter higher. This is, of course, putting the cart ahead of the horse, but knowing these past strong correlations will help us keep our emotions in check as market pullbacks challenge our resolve. Using this data as a backdrop, statistically, the outlook remains favorable for the rest of the year, in spite of any pullbacks we may experience. To try and break up from the repetitious monotony of showing charts and uptrends, I'm going to do something a bit different this month. For the first half of the video, I'll be reviewing a few charts that I find interesting. The second half will be to look at past parabolic markets. In past videos, I have mentioned the possibility of the stock market eventually going parabolic. I heard from a few of you asking for more details on what I meant by parabolic market, so I thought I'd take the opportunity to educate. Let's go do it. My first chart is that of the global Dow index, which is made up of 150 constituents from around the world. The 150 companies are selected not just based on size and reputation, but also on the promise of future growth. The index has been designed to cover both developed and emerging countries. It's a great proxy for what large cap stocks from around the world are doing. Those that are chart fanciers like me should find this one a thing of beauty. Price is climbing strongly as it's above both a rising uptrend and a 200-day moving average. Short term, it is massively overbought and it's in need of a pullback, as you can see reflected in the RSI momentum in the upper pane, reaching the highest value in the last 5 years. As such, I expect we should see a correction in the near term. Not necessarily the subtle 3 to 5% that we've been used to, but something more maybe in the double-digit range. A good proxy for the health of U.S. stocks is, of course, the technology sector. And one of the most important components of technology are the semiconductor stocks. Their health cannot be overstated if we want to see higher U.S. stock prices. As you can see in the chart, like the global Dow, semi-stocks are in a clear uptrend above both the rising uptrend line and their 200-day moving average. Notice the negative divergence that is formed in the upper pane of RSI momentum. While not a sell signal by itself, this overbought divergence is a warning sign to expect the possibility of a bigger than normal pullback, forming a lower low. My next chart is that of gold. As you can see, it's formed a very nice wide base, which, if launched higher, signals the low has been made and a new uptrend has begun. The target for this pattern, if it completes, is up near 2012's prior high at the $1,700 level. A note of caution to the gold bugs though. The pattern has not triggered. It has not yet broken and held above the pattern's neckline. Until then, gold should be watched and not owned. For those that did not read last week's post regarding interest rates, I thought it worthwhile revisiting the interest rate chart. The higher rates go, historically, the more challenging the environment for equities. In the earliest stages of their rise, they typically have a positive impact on stock prices. It's not until they reach 4 to 5% on a long bond before investors begin converting their equities into bonds. This chart is that of the 10-year Treasury rate. As you can see, it's broken out above the consolidation pattern to the upside and has a target back at 2013's highs, near 3%. When it comes to rates and stocks, absolute rates aren't the only concern. The spread between the long and the short bond can be of greater concern. This next chart is the spread between the 20 and 2-year Treasury bond. As you can see, the spread is declining. A declining spread indicates a flattening yield curve, something stock investors would prefer not to see. Stepping way back and looking at spreads as far back as my data allows shows that while the spread is shrinking, this is not the lowest it's been, by a long shot. But because of its importance, this is something I'll be watching very closely. My last two charts before I move on to looking at parabolic markets are studying the ratio of stocks to bonds. Specifically, the S&P 500 index as compared to the 20-year U.S. Treasury bond. Those in stocks want the direction of the ratio to go up and to the right. As you can see in the first chart, the good news is that's exactly what it's doing. The cautionary news is that the RSI momentum in the upper pane has once again reached overbought territory. To put this into perspective, let's take a look at the ratio, but over a longer time frame. In the upper pane is the RSI momentum, the middle pane is the ratio, and the bottom pane is the S&P 500 stock index. The yellow flag here is that, as you can see, each time the ratio has gotten overbought, the S&P 500 has had a pullback. Some have been quite mundane, while others have been quite significant. The takeaway here is that there is nothing in the ratio that says we need to step aside from equities right now. But risk-averse investors should consider taking some chips off the table, as indicators are warning of a pullback. In past videos, I have mentioned we're getting closer to the possibility stocks eventually enter into a parabolic blow-off. I got the hint that not everyone knows that term, so the last half of this video will be to look at what they are, why they happen, and what you can expect if they do. Parabolic blow-offs are generated when a steep rise in prices occur, which are caused by irrational buying and intense speculation. They're rather rare, but occur across all investment types, not just stocks. Once they begin, they generate a mega bull trend. In the beginning stages, the investment breaks out usually from a long consolidation and begins a gradual uptrend, making higher highs and higher lows. Irrational buying generates a stronger rally and eventually pushes prices vertically, as the fear of missing out emotion, it kicks in. Once prices begin their parabolic vertical rise, they all have very predictable outcomes. A steep sell-off typically is dramatic, if not steeper, than the ascent. Although they are predictable, they're difficult to trade and manage. Yes, I did say trade. These should not be bought and held. They should be viewed as a rental only. On the upside, bullish sentiment gets ridiculously high, and everyone is making money, which draws more and more people in. But as there becomes fewer and fewer buyers, the sellers take control. The smart money exits, and the bag holders eventually are looking for the exit, all at the same time, pushing prices down so fast, by the time they do react, well, it's too late. Prices have already collapsed. Most blow-offs end in a significant correction of 62 to 79% of its price rise. Once the dust settles, most often it's best to move on and look for other opportunities, since prices typically take a very long time before they return to their pre-blow-off highs. Let's take a quick look at a few examples across a number of different investment types. The first chart is that of a stock, Ambarella. As you can see, it broke out of a nice base here. It back-tested the support line and then moved higher at a good but reasonable clip. In this case, the start of the vertical move was kicked off by a huge volume spike, and prices climbed more than 100% in 4 short months. Sellers eventually overwhelmed buyers, as you can see here, where the largest volume marked the end of the uptrend. This is a great example of an exhaustion top. The next chart is the second half of Ambarella's blow-off journey. As you can see, it made one more attempt to go higher, giving those who missed out a chance to exit, but before the rug was pulled out. From that high, Amberella fell 75% peak to trough. The next example is that of cotton. The price of cotton moved higher after breaking out of this base. Notice again how price fell back to retest the breakout level. It held, and then it used it as a springboard to move strongly higher. Interestingly, cotton had two parabolic moves, one right after the other. While it does not often occur, it can happen within a very strong uptrend. After peaking, prices fell back here to its original uptrend line, losing only 38%. It then formed its second and stronger move. Notice during both blow-offs, momentum was falling while price continued to rise. This is a classic example of negative divergence. Like all divergences, this one was a warning sign of things to come. Unfortunately though, divergences can go on for a long time before they actually matter. In this case, cotton rose more than 100% before the divergences actually kicked in. The next chart is the second half of the cotton blow-off. Like Amberella, cotton buyers stepped in to attempt to continue the move higher, but failed at prior highs, marking a reversal top as its price fell 50% in 4 short months. This is a great example of a double top. The next example is that of silver. This setup should look familiar by now. Price broke out of the space, and while it may be hard to see, it too did a short back test to its breakout level and launched impulsively higher. Silver's climb ended in buyer exhaustion combined with overbought momentum. As you can see in the follow-up chart, silver did not make a second attempt to push to the highs. Instead, it collapsed, falling 35% in 1 month. You might be thinking that blow-offs are supposed to find a bottom 62 to 79% from their peaks. Keep in mind, those numbers are guidelines, not absolutes. But, in fact, while I'm not showing it on the chart, silver actually bottomed 72% from its peak. The difference is, it took more than 4 years to establish the bottom. My final example is that of Bitcoin. I think you've heard of that before, haven't you? Notice the base. Notice the backtest to support. Notice the launch higher. How about the overbought momentum and divergence? What comes next? Yep, the crash. So far, it's declined 69% in less than 2 months. The chart does not look like the decline is over, so 69% may be a conservative number once it's all said and done. But we will only know this in time. Before moving on, I do want to point out that, like cotton, Bitcoin went through 2 blow-offs, a testament to the strength of its bull market. That's it for blow-off examples. Hopefully I've provided you enough insight to not only recognize what to look out for, but also show you that because of their detrimental impact they can have on your wealth, they need to be tightly managed or even avoided. With that in mind, let's see if I did a good job by putting that newfound skill that you got to a test. Here's a current chart of the US S&P 500. What do you see? A base? A back test to the base? A breakout? A springboard to a parabolic move higher? Massively overbought RSI momentum conditions? Yeah, me too. Only time will tell if this will play out with a sharp decline as my prior examples. But hopefully by now you understand my mention in prior videos. Until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with January 2018's Charts on the Move.